The gold-to-silver ratio is more than a metric, it is a window into the market's psychology, its fears, its expectations, and its blind spots. And right now, something extraordinary is happening. For years, investors accepted a ratio that hovered near historic extremes, often above 80:1, and even touching levels that made no fundamental sense. That kind of disconnect between two deeply related monetary metals usually signals one thing: the market is mispricing risk, innovation, and future demand. Today, that imbalance is finally being questioned, and silver is beginning to force a revaluation that few saw coming. When we examine the structure of demand, the shift isn't a mystery. Silver is no longer simply a precious metal. It is a critical component of an electrified, digitized, renewable-driven world. Every major technological transition, solar expansion, battery innovations, advanced electronics, autonomous systems, pulls silver deeper into the heart of global supply chains. And while demand rises, supply remains constrained, with mining output failing to keep pace with the industries now depending on it. Markets can ignore fundamentals for a while, but eventually reality asserts itself. We're seeing that assertion now. Gold, on the other hand, continues to serve its timeless purpose, preserving purchasing power during uncertainty. Its role hasn't diminished. If anything, in an era of geopolitical tension, persistent inflationary pressures, and currency volatility, gold is performing exactly as expected. But that stability is precisely why the ratio is compressing, because silver is not moving for the same reasons gold moves. Silver's acceleration is driven by structural demand, not temporary sentiment. When two assets share overlapping monetary functions but diverge in industrial necessity, the market eventually corrects the mispricing. This is the phase we have entered. When people speculate about the ratio collapsing toward 7:1, the number isn't random. It's tied to the idea that the market might one day reflect something closer to the physical relationship between the metals, how difficult each one is to extract from the ground, how scarce each one truly is relative to global needs. Whether or not we reach those levels isn't the point. What matters is that compression is clearly underway, and it signals something much more important: a fundamental repricing of silver's role in the global economy. We are watching a shift from silver being treated as a junior gold to being recognized as a strategic industrial metal with monetary leverage. This transition is not sudden. It builds quietly through technological adoption curves, long-term infrastructure commitments, and compounding deficits. But when the market finally responds, it responds abruptly because years of mispricing unwind in a fraction of the time it took to create them. That's what makes the current phase so compelling. Silver is not simply rising. The ratio itself is telling the story of where capital is flowing and why. The real question is not whether the ratio could compress dramatically, but what accelerating compression signals about the broader economic environment. Historically, rapid declines in the gold-to-silver ratio have appeared during periods of intense innovation, industrial demand, and shifts in monetary confidence. Each time, they indicated a reallocation of capital toward assets aligned with technological and structural change. Today's world is undergoing one of the largest industrial transitions in modern history, and silver is positioned at the center of that transformation. The ratio is reflecting this not as speculation, but as a recalibration. When markets wake up to multi-year imbalances, they correct faster than anyone expects. And as silver continues to assert its relevance in both the monetary and industrial spheres, the compression we're witnessing may only be the early stages of a much larger realignment. Investors often underestimate exponential change because they expect the future to behave linearly, but technological revolutions do not operate on linear timelines. They accelerate, converge, and compound. Silver is benefiting from exactly that kind of convergence. Gold remains strong, but silver is rewriting the narrative, and the ratio is finally telling the truth the market ignored for far too long. The gold Silver ratio is sending a signal the market can no longer afford to ignore. For years, the disconnect between silver's true structural demand and its suppressed pricing created an illusion of stability, but illusions don't last in financial systems undergoing technological transformation. Silver is no longer simply trailing gold like a passive follower. It is behaving like an asset waking up to its own relevance, and the speed of this ratio's compression reflects that awakening more clearly than anything else happening in the precious metals space right now. The ratio soared to extreme levels in recent years, well above the historical average, essentially broadcasting that silver was deeply undervalued relative to gold. Those anomalies don't persist in markets where macro forces and industrial demand begin converging. And that convergence is happening at full force. Consider the sectors reshaping our global infrastructure: solar energy, EVs, AI hardware, advanced electronics, battery storage, and high-efficiency power systems. Silver is embedded in the future of every single one of these. Gold's role, timeless, stabilizing, protective, remains intact, but silver's dual identity is becoming impossible to ignore. It's both a monetary metal and a high-demand industrial necessity. That combination has always been powerful, but for the first time in decades, it is exerting real pressure on price action. The ratio crashing faster than analysts expected isn't a speculative anomaly, it's the market catching up to years of underappreciated fundamentals. The supply side remains tight. Even as technological needs accelerate, mining output has barely expanded and in some regions has contracted. Silver's deficits aren't theoretical, they're structural. And structural deficits produce long-term price consequences. When demand growth is exponential and supply remains linear, the recalibration is inevitable. We're witnessing the early stages of that recalibration. What makes the current movement even more compelling is that silver is outperforming not because gold is weak. Gold is strong, resilient, and behaving exactly as a safe haven asset should during global uncertainty. Silver's outperformance is happening in addition to gold's strength, not because of its weakness. That tells us the ratio's compression is not a crisis response, but a strategic revaluation. Investors are not fleeing gold. They're simply recognizing that silver has far more catching up to do. The market is pricing in the future, and the future is electrified, digital, decentralized, and resource-intensive. Silver sits at the core of that evolution. When you examine cycles of innovation, the pattern is clear. Markets often react late, then move all at once. They underestimate emerging exponential trends, then scramble to reprice assets once the data becomes undeniable. Silver is following that pattern. Its industrial relevance is no longer speculative, it's quantifiable, measurable, and strengthening quarter after quarter. Every trend that defines the next decade: energy transformation, computing power, mobility, and grid modernization, demands more silver than the system is structurally prepared to supply. That is why the ratio is collapsing. Not because of hype, but because the fundamental underpinnings of silver's utility are accelerating. When a metal becomes essential to the infrastructure of a new era, markets eventually reflect that necessity. It doesn't happen smoothly or predictably. It happens in spurts, with long periods of compression followed by sudden surges. We are in one of those surges now, and the ratio is capturing the velocity of that shift. So the question isn't whether silver is about to explode. The real question is whether the market has fully priced in the technological era we are entering. Gold remains a stabilizer, a store of value with thousands of years of trust behind it. But silver is becoming something more, a bridge between the monetary past and the industrial future. The ratio is adjusting to that reality, and if the current trajectory continues, the world may look back on this period as the moment silver finally reclaimed the valuation that its fundamentals have been demanding all along. When we talk about the gold-silver ratio being broken, We're really talking about a distortion, an imbalance in how the market values two metals that have been intertwined with human history for thousands of years. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold, simple in concept, profound in implication. Today, that number sits well above long-term averages, indicating that silver is historically cheap relative to gold, an unusual situation given silver's dual role as both a precious metal and an industrial input. Use a gold +1 historically, the ratio has swung wildly. In ancient times, civilizations often fixed it between 12, 1 and 16, 1 under bimetallic monetary systems. Once markets liberated these prices, the numbers began to fluctuate dramatically from lows around 15, 1 during precious metal manias to peaks above 120, 1 in crisis conditions like the 2020 pandemic. In early 2025, it remained elevated in the range of roughly 80 to 90 ounces of silver per ounce of gold, still above the long-term average. Use a gold +1. What does that tell us? It tells us silver has been undervalued relative to gold. This is not just a technical footnote, it reflects deeper shifts in global demand and supply structures. Gold's valuation is primarily driven by, say, haven flows, central bank reserves, and macroeconomic hedging. Silver shares in some of those drivers, but it also pulls price influence from its intense industrial usage, from photovoltaics to electric vehicles and cutting-edge electronics. That duality, partly monetary, partly industrial, makes silver fundamentally different from gold. And that difference is now manifesting in the ratio's behavior. Gold, silver, Japan +1 right now. Silver prices are at historic highs, having rallied past $60 per ounce in late 2025 amid supply constraints and surging demand. This surge has outpaced gold's gains in some periods, and that's extraordinary, because gold has remained a primary store of value in an environment of persistent economic uncertainty. The industrial demand narrative is not a fringe idea. It's driven by real needs in global infrastructure and technology. Even as gold benefits from inflation concerns and geopolitical risk, silver is also in a structural deficit that's persisted for multiple years, with production unable to keep pace with consumption. Financial Times +1 so when analysts talk about a 7-1 reset. What they're referencing is another type of ratio, one grounded not in price but in physical reality. If you look at how much silver and gold actually come out of the ground, estimates place the mining production ratio near 7 or 8 ounces of silver for each ounce of gold produced. That is very different from the price ratio, which currently sits around an order of magnitude higher. That discrepancy is exactly what raises eyebrows in markets, because if the supply dynamics were fully reflected in prices, silver would be priced much closer to gold relative to how both are extracted and used. This is why some analysts are not just watching the ratio, they are watching it, anticipate a fundamental normalization. The ratio isn't broken in a mechanical sense, but it is stretched. Market distortions of this nature don't adjust slowly. They compress in fits and starts as fundamentals catch up. When industrial demand accelerates, inventories tighten, and investors start placing real strategic weight behind silver, the ratio begins to correct, not because of speculation, but because the underlying economic data has changed. Invest in that sense, the conversation about a dramatic reset, whether toward 7-1 or toward any other historically tighter range, is really a conversation about valuation, scarcity, and industrial convergence. The historic averages don't get hit very often, because markets spend most of their time in pricing discovery, not in perfect equilibrium. But when we see persistent imbalances that align with strong structural forces, supply deficits, robust demand, and evolving technological needs, the ratio becomes more than a statistic. It becomes a barometer of change. And right now, that barometer is reading a trend toward recognition of silver's worth not just as a companion to gold, but as an asset with its own demand drivers that are increasingly fundamental, structural, and lasting. That's the real story behind the warnings about the ratio, and the talk of a reset. Markets are not static, and valuations reflect shifts in the world economy in ways that textbooks often overlook. The gold-silver ratio may look broken only because it has not yet fully realigned with the forces that now define value in the 21st century. What's happening right now in the precious metals market, it isn't ordinary, it's a structural pivot that's been building for years and is suddenly becoming visible in real-time price action. The gold-silver ratio, long used as a gauge of relative valuation between the two metals, has been compressing, and the momentum behind that compression is something even seasoned analysts are calling a danger signal, not for crisis, but for transformation. This isn't just a headline, it's a market evolution that reflects shifting fundamentals in both metals and the broader economy. Use a gold plus one at its core. The gold-silver ratio is a simple metric: how many ounces of silver you need to buy 1 ounce of gold. Historically, this ratio has swung widely depending on macro conditions, investor sentiment, and structural demand for each metal. When markets are unsettled, gold, the ultimate safe haven, tends to outperform, pushing the ratio higher. When industrial demand and growth expectations dominate, silver begins to outperform, bringing the ratio down. That dynamic is exactly what we are witnessing now. Use a gold plus one. What's remarkable about the recent movement is how fast silver's price has been catching up to gold's. In 2025, silver has not just participated in the rally, it has outpaced expectations, surging toward record levels driven by a convergence of factors that extend well beyond traditional safe haven demand. Silver has been breaking records, pushing above $60 per ounce as inventories tighten and demand from technology and energy sectors escalates. This surge is occurring even as gold remains strong and continues to attract capital amid ongoing geopolitical and economic uncertainty. Financial Times plus one. Today's compression of the gold-silver ratio isn't a fluke. It reflects silver's dual role in the modern global economy. Unlike gold, which is driven primarily by its position as a monetary anchor and hedge, silver is being pulled upward by industrial demand that is expanding faster than supply can keep up. From solar panels and electric vehicles to 5G infrastructure and advanced electronics, silver is woven into the fabric of the technological era. These structural drivers are real, measurable, and persistent, not speculative trends. As global manufacturing and technological deployment accelerate, silver demand is rising at a pace that's fundamentally reshaping its valuation relative to gold. Discovery alert plus one. Another factor contributing to this shift is the distinct way central banks and institutional investors treat these metals. Gold continues to benefit from robust safe haven flows and central bank accumulation, a pattern that has underpinned its resilience for decades. Silver, by contrast, does not enjoy the same level of institutional backing, but that very disparity is creating a leverage effect. When industrial demand spikes and investment interest follows, silver's smaller market size and greater volatility can lead to outsized moves compared to gold. The ratio compresses quickly when silver begins catching up, and that's exactly what markets are pricing in now. CME Group, at the same time, technological and economic trends are increasingly favoring silver's industrial footprint. With supply deficits persisting in the silver market over multiple years, inventory drawdowns and mining constraints have tightened the physical backdrop. This scarcity pressure is not artificial, it's structural. And when supply cannot elastically respond to burgeoning demand from sectors such as photovoltaics and electronics, prices react accordingly. This interplay between supply constraint and rising demand is a core reason silver's valuation relative to gold is tightening faster than many expected. Financial Times +1. So why are analysts warning about this danger zone? It's not because markets are collapsing, it's because the traditional relationship between these metals is being rewritten. The long-standing assumption that gold would always dominate silver in terms of investor preference is being challenged. Silver's price behavior suggests that markets are no longer treating it as a secondary precious metal. They are treating it as a strategic asset with meaningful industrial leverage and monetary appeal. In this context, the gold-silver ratio is not just a number, it's a signal of deeper structural change. The rapid compression reflects a broader reallocation of capital and recognition of silver's evolving role in an economy driven by technological innovation and energy transition. If this trend continues, it could redefine how investors think about precious metals across portfolios and strategic allocations. This isn't a speculative shift, it's a recalibration grounded in real economic forces, changing supply dynamics, and evolving patterns of global demand. J. Rothbart & Co. +1